All right, here we are, September 6th. Going to be conducting session number 8 today. Going to talk about probabilities and then talk a little bit more about a couple different ways to enter the market so we could start to put together, the 4 steps that we use to quantify the different conditions of order flow along with actual ways to enter the market, and talk a little bit more about the aggression factor. The variable about the different combination of what conditions we have in effect, trade location, and position sizing. All very important information, and all things that always create a little bit of a variable from one trade to the next. That's why we're really never going to have one trade that is exactly the same as any other trade that comes up throughout the period of the day. Now, first thing we're going to do here, we're done trading for the day. For the most part, very inactive day. I think 200 and change of this was from last night. I think maybe we had 5 trades on the day. Definitely more opportunity out there than what we took advantage of. Just based on our context, my own personal context, and everybody's going to have their own different context on a daily basis. You're going to have your normal context, your normal type of trading habits according to what time of the day you're more active in, whether you're active for the whole day or not. But then you're going to have days that a little bit out of the norm, where maybe you're not on your game, you have distractions, maybe you had a bad day the previous day at home, whatever the case may be. If you feel like you're not on your game, can't urge you enough to just either not trade that day or take your size down a notch. Very important. If you feel like your focus isn't there, or you're discombobulated for whatever reason, the markets are always going to be there, guys. You see us every day, day in, day out. There's opportunity in the market, and as long as we always have a handle on our risk, and we know we're trading with an edge. So if we have a handle on our risk, we're not ever going to take a trade that's going to put us out of business, or a series of trades that's going to put us out of business. Then the profit's going to take care of itself. So the first thing that we're going to do today is just do a quick review of zones. We got to update these zones and update our inventory positions here, our inventory levels on the order flow. And then we'll get into some subject material. Couple questions there. Top of chart 2 is not moving. Okay, it's moving now. On the FG scale, bottom right, reading is minus 1,000. Minus 10,000, 60,000. Yeah, that's a good question, and that number is, odds are it's going to be different. Number one, if you're using a different data feed, it's going to be different. But even if you're using the same exact data feed, it's not the number itself that's important. It's the difference between the two numbers. If the difference between my swing low point and my swing high point on a day is 100,000, just for the sake of using round numbers, and yours is showing 75,000, then you know you have a data issue, because I'm using DTNIQ, very accurate data. That's the best way to compare the difference between the two numbers, because even if you were using DTNIQ, if you have 15 days of data and I have 16 days of data loading into the study, right now I'm showing 60. Even if that's a day off, your numbers are going to be different than mine. So the number itself is unimportant. I don't pay any attention to whether this number is minus 705 or minus 505. Doesn't really matter. What is important is the difference between levels. They should be uniform. And I rarely even pay attention to that, but if you're looking at numbers and say, oh, you know what, hey, 30,000 contracts were put on today to the short side, or whatever the case may be, it's really the only time that we look at numbers. But the actual number itself doesn't really come into play as far as the methodology. Well, you got to make sure that you're on the same amount of days being downloaded. You have to make sure you're on the continuous contract. If you have an issue at that point, then we should definitely look into it, because one of us is having a data issue at that point. But again, it's the difference between the swing high, which right now I have at 675, roughly speaking, maybe 674. And on the bottom, we're talking about maybe 718, 719. So, what are we talking about? 44? Difference of around 44,000. Somewhere in that neighborhood. Hold on one second, guys. This is actually the guy that's going to be doing my hookup. Hold on one second. Yo, what up, brother? I don't know if you can come here tonight, but all right, guys. So back to the session here. What we're going to do first off is going to update our zones, and let's slice up this demand a little bit better here. This was a dynamic zone that we had put in. Remember, demand was still forming. We never updated it by the when the profile finished ending. So let's just get rid of that. Let's slice up our demand picture a little bit here. I'm just going to call this demand right now. The market, this profile opened up, came down, tested this value transition. Well, not really a value transition because it was within the trend that had already started, but came back, tested previous wholesale value after some horizontal development, closed here. Next profile opened up, came back down to test the bottom of this value zone, and then shot out of there. This is the first time the market's coming back down into here. We'll call that blue. Since all of this value here has already been retraced and breached, we're not gonna highlight anything in here. Let's try and split this out a little bit. Let's see what we come up with up here for supply. You see where it went to, guys, right there? High volume point. Still the high volume point, but this is a nice, better little slice of value there. Now, by splitting that out, we're able to come up with a little bit over a 2-point zone here. It's kind of where the market's getting caught up in right now. Market sold off, came back down to test previous demand, and is rallying up into the zone as we're seeing now. So let's split this up here, create a demand zone down here, updated demand zone right here. Okay, the market came up to here, sold off, came down to here, made a swing low, got rejected. Demand overcame supply, so there's going to be a demand zone. Color that blue. And we got the market coming up. Responded, reacted at the zone a little bit, gave a couple of tradable rotations, and now they're pushing through it, so we're going to take that zone off. It's been breached. It's a thing of the past. Short-lived, thing of the past. Don't ever have to worry about it again. And we'll just let this run right into the close. A little bit of imbalance in here, kind of an anomaly type of looking profile here. Skinny, narrow, and stretched out. Really not much in the way of inventory events today. There are a couple of opportunities. Overall, in light of this big move down since Friday's close in the 1270 area, the market's really been imbalanced. I mean, in a state of balance here today, a little bit more so than I would have thought. You know, the markets seem to be moving. There seemed to be more range in the price, in market price, than there seemed to be a range in order flow itself. kind of a strange day. And again, I don't know if it's because I'm a little out of sorts and I've been away from the markets for a few days. Um, just get that feeling, just a little bit of a out of the ordinary type of day here. But let's update these inventory level there. Now we got a little bit of short covering coming into the close here. You know, and if you think back to what I was saying at the end of the morning session, uh, one of the guests was commenting that there, was a lot of weakness. The sound is garbled. Can anybody hear me okay? Anybody else having problems with sound? Yeah, I think it might be your end, Eric, because I think everybody else is okay with the sound. A little garbled for you too, Paul? All right, let me see something here. Hold on one second, guys. Let me. I'm gonna shut my dome down. Shut my trading platform. Gonna shut a couple of other things down here. Save some resources that I don't need right now. It could be the fact that I'm trying to record this session and that's messing with the bandwidth. You know what else? I'm gonna shut Skype down. Let me shut Skype. Alright, how does that sound now? Any improvement on the sound? Yeah? Okay, good. So as we were talking about towards the end of the session, and again, this is a little bit more advanced, and we'll get more into the order flow aspect of things for this new workshop session. Is going to be either Monday, Tuesday, or Tuesday, Wednesday. But we had a situation this morning that, yeah, the internals, market internals, as far as the cash market, definitely weak. Breadth was weak. They were running some sell programs, and they could have, if their intent was to push it lower, they could have taken the S&Ps lower by continuing to push with sell programs uh, to cause some further liquidation in the cash market and equities. But barring that and barring any outside news event coming in and affecting the market, it would be very hard for the market, and we're talking about the S&P futures at that point, to head any lower because there was no long inventory in the market to create supply. So when you are faced with a market condition of having long inventory as the market is selling off, that long inventory is potential supply. That is extra supply that could come into the market and feed that down move. But when you have a condition like we had this morning where there was no long inventory in the market, it's hard for the market to go any lower at that point. Again, the smart money's not selling new lows. We know that they don't sell after a period of selling. They don't sell at retail prices, wholesale prices. Right? If they're going to be short, they're going to sell the upticks into retail pricing, not at wholesale pricing. So the smart money's not selling lows. There's no longs to be squeezed out. You're kind of really running out of sell pressure there, a potential sell pressure. And again, it doesn't mean the market can't go lower at that point. It could. If outside news came in, if equities kept pushing sell programs, they could definitely force the market lower at that time. But sometimes, their agenda entails just running the inventory out, running the stops from the S&P futures traders. Once they're run out, there's no more potential supply to come into the market. So that's kind of the condition that we're in. And playing it conservative rather than looking to buy the downtick. Let's take a look at this morning too, and we'll see if we get an example of being able to now this was the zone that was formed, so instead of just jumping into the market here on the vertical development. Even though it wasn't intense, it wasn't really an environment of intense liquidation coming in, intense sell pressure. We had some nice divergence. Divergence was already coming into the picture here. More divergence here. You're talking about 10:30 into the 11 o'clock hour, right about in here. The market formed a new value zone here. So instead of, if you want to take the conservative approach, you're not looking to get in here, you want to see proof of a buy response. It's a good example of our value transition, right? You left the market pop to the upside, and you're looking to buy these downticks into this newly formed demand zone in an area where we could see that demand overcame supply in this area, right? The market was not able to push any lower. Market probed higher, gained a little bit of acceptance here, came back to test. There's your spot to buy the downtick, and then you actually had another opportunity right here to buy a downtick. This one with divergence, right? So the market gave a couple of opportunities there if one didn't want to get in front of that down move with no inventory levels to lean on. You wait for the market to stop going down. Let it prove that there's no more supply. Let it further prove a buy response, and then look to buy that downtick. Good example of a value transition there. And now we just got into a nice short squeeze here, actually getting into an inventory transition at the close here. You know, this is a time of the day that we're not really looking to trade. Where are we here? But an inventory transition is an inventory transition, you know, no matter what time of the day it takes place. But, you know, the dynamics right at the end of the day, just like right at the end of the week, they're a little bit different, a little bit trickier. You know, it comes down to whoever's taking heat at that point doesn't want to be in the market anymore. Traders can't keep those trades overnight. They can't keep the trade from the day session into the Globex session because of the huge increase in margin. So they need to liquidate those trades. So it's a little bit of a different dynamic coming into the market at that point. But this was the type of inventory transition that I would have been waiting for to liquidate, to initiate a short trade. Next level up is over here. Let's get a little bit of a better perspective here. So they got everybody out as far as any short inventory that's been put on today or yesterday. And they started to get up to a point where they were squeezing some shorts that were put on at the close on Friday. Now, price is actually back to the level where these guys got into. Oh no, actually no, price is a little bit higher. Price, this was this move here at the close on Friday. So these guys are not getting squeezed at this point. You know, they're not taking heat on their positions. So they're standing pat. You know, one thing we did notice today throughout the day, which is going to be interesting to see how it plays out overnight, but you know, there was a lot of commitment to the short side. Okay, the market got to a point this morning, it couldn't go down any further at that point in time because there was no more supply coming into the picture. Then the market turned around and they wound up squeezing some late to the party shorts. But bigger picture is there's still a lot of short inventory that is really staying committed here. And even though they didn't get the price improvement to new lows this morning, you know, where they were able to take out the overnight low and head lower, they're still staying committed to a certain degree. So definitely something to watch overnight and pay attention to. Keying on these inventory levels. Number one, this inventory level that was created right here now on the close, and next level up of inventory from, you know, midday on Friday. Those are going to be the next levels that we're paying attention to at the close on Friday and midday on Friday. We'll key on those levels overnight and again tomorrow. Any questions at all about anything specific from today's trading? There was some pretty clear-cut opportunities. No real good swing type of situations, in my opinion, today. But what I did notice, the constant theme today was shorts trying to stay committed after they made that swing low this morning. All right, let's update this zone while we have it here. This zone was taken out. Let's see where this zone is coming from here at 66. This swing point Sunday night. Market opened up here Sunday, sold off, headed to the upside, created this swing zone, this retail zone, supply zone. The market sold off from here. It's the first time the market's coming back up to this level to test. This is the last level of supply before we get into that gap that was created on the open from Sunday, right? They probed a little bit into it, but we have a lot of unfinished business here that we have to actually update here. All right, from the close on Friday. Down into the Sunday night open. Nice little gap there with some imbalance that came in on the close on Friday. It looks like that level is getting closer into their sights. And it makes sense, you know, it's extreme imbalance. When you have a gap, and this is really one of the only true gaps that you get in the S&Ps from the close on Friday into the open on Sunday. There's literally no trading taking place for a day and a half. Represents inefficiency. It represents unfinished business to the market. The market wants to come in and test this area for demand, see if there's any demand above. So it makes sense if they're able to take it up higher, squeeze out some short inventory overnight, that they're going to take it up and hit into these levels at that point. Now, we're not saying that's going to happen. In fact, from what I've seen already today so far, it seems like shorts are not getting squeezed out and they're trying to stay committed. So that scenario would actually be the one that would surprise me more so than waking up tomorrow and seeing further weakness. But we'll see. We'll see which way it plays out. Either way, we create these if-then scenarios, and we're open to either direction. I don't really care which way it goes. All right, guys. So let's talk about, if everybody is okay with what we went through. You know, the students that have been through this past session. We're going to talk about probabilities a little bit here for a few minutes. Very important aspect of trading, you know, and it's more about concept. There's no mechanics with it. It's more about concept and just understanding the whole idea of trading being a business that's based on probabilities. That, you know, it comes down to trading in the market with a consistent edge. You know, that's what I do, and that's what I teach. That's my goal in teaching. You know, what you do with that edge ultimately, how you decide to run that your business, it's going to be up to you as time goes on. At least initially, I'd like you to keep the same mold as I am and trading the same types of trades, looking at opportunity through the same lens. But as time goes on, and you're going to create your own type of trade plan, your own trade management, as far as whether you want to be more of a active scalper or maybe you want to be more of a swing trader. You know, that's going to be up to you. But at that point, you're going to have that foundation in place. You know, and that's the purpose of this education, to put that foundation in place. But when we say we trade in the market with a consistent edge, what we're talking about is that we only enter trades when we're confident that we have probabilities in our favor. That's what it comes down to, guys. We're not talking about certainty of outcome. We don't have a crystal ball. We don't know ahead of time where the market's going to go. Anything can happen at any time. But we are talking about knowing the odds with certainty. We know when we have certain conditions in effect that we can expect the market to react with a certain degree of probability. We're talking about the odds being stacked in our favor. And our goal as traders is to identify the high probability, low risk price zones ahead of time. Okay, that's step one. That's half of our core methodology. Step two is knowing what we want to see happen at these key areas in the order flow, right? When price comes into the zone, what do we want to see in the order flow? Are we looking for commitment? Are we looking for divergence in the buy pressure? Are we looking for an inventory transition? It's the synergy between those two separate aspects of our methodology that really come together to stack the odds in our favor. But even so, guys, and this is critical to your maturity as a trader, you have to be willing to change your mind, whether it's at the last minute right before you put on a trade, or if you're in the trade and the market is all of a sudden telling you something different. Order flow is switching. You got in, you were getting short. Looked like there was a demand vacuum. You're waiting to see supply come into the picture. Now you see there's no supply coming in the picture, and worse yet, you see demand picking back up. Well, guess what? Maybe it's not such a good idea to be in that trade anymore. So you got to be willing to change your mind as the market gives you more information. If the market tells you something different, we have to adapt to the ever-changing order flow conditions. Order flow conditions can literally change from 1 second to the next. What we're basing our trades on is what's happening in the order flow at that point in time. And we get into the trade, we put our trade on, and we monitor it. We monitor it for continuation. Anything can happen at that point. You know, we could see demand dry up. We could start to see supply come in, and all of a sudden, a huge trader somewhere in the world decides he wants to buy 1,000 contracts. Well, guess what? That's going to be demand coming back into the picture. The market might need to head higher to take care of that demand. There's no way to foresee that. You know, and that's going to change the order flow picture a little bit. More so on the lower time frame than it is on the higher time frame, but it is going to change the order flow picture a little bit. And if we're scalping, we're really keying in on those bits and pieces of information that's coming through the order flow. Right? So on one hand, you have to be able to get into the trade based on what you're seeing. You have to accept the risk and the uncertainty that's always going to be there. But what allows you to do that is the fact that you know you have probabilities in your favor. A lot of my trades, guys, you see, a lot of times I'll say I'm probing here to the short side, see if we can get into the rhythm, put on a short sequence. A lot of that is putting the trade on and monitoring for continuation. You know, knowing I'm in a good spot, knowing I have halfway decent to really decent trade location, knowing I have maybe one or two of my conditions in effect, start to probe a little bit, put the trade on and monitor for continuation. If I'm at the top of the range, if I'm at the edge, I'm at retail pricing, I'm coming into a zone, the scenario is one that I've planned and thought about, that I'm going to put the trade on. You know, if you want to be a day trader, these are the type of trades that you're going to want to be able to execute. You know, and as you mature as a trader, let's put it that way. In the beginning, listen, it's perfectly fine to wait for textbook situations all day. You're going to be a lot less inactive, but they do come around. But as you mature as a trader, you're going to see a lot of opportunities. You see me trade these opportunities, and it could be on a scalping time frame, it could be on a swing trade time frame. But you see me put these trades on, and it's a matter of I get into the trade a couple times today, work a minimum size today, put the trade on, and if I'm not getting that immediate improvement that I want to see, I'll immediately start to take some inventory off the table. Give it a little bit more time, see if I get any more price improvements, see if I just got short, do I see them still running buy programs in the cash market, or do I see some sell programs coming in? Do I see a little bit more of a sell response in the order flow? These are the things that you want to see as you just got into a short trade. But ultimately, it's about the probabilities, you know, and I severely misunderstood that for the longest time. You know, it took me quite a while to really believe and understand how simple trading can be when you break it down as far as probabilities, and you get off that journey where you're looking for that holy grail that's going to give you 100% winners. You know, that holy grail that's going to tell you what the market's going to do every minute of the day, or tell you how far this particular move is going to go. We have no way of knowing that stuff. You know, but just accept the fact that we don't know the outcome of any particular trade. But over time, you'll make money if you have some kind of edge. So even though each trade is random, you accept that trading basically comes down to is just a numbers game. And over time, if you have an edge, you're going to be profitable as long as you're containing your risk. Another hugely important thing that I like to share with you guys over and over again, you know, it's my core belief, and I'm sure a bunch of you already know this by heart, but you know, the number one thing that helps us as traders is to make it a core belief that we absolutely positively never know what's going to happen next in a trade. Each result is a random event. And by believing that, we'll have no attachment to a position, and the result of each individual trade has no bearing on our ego or emotions or how we trade going forward. You know, it's not too often that I have a losing day. We have losing trades here and there, but you guys know, even on a day where I'm taking a lot of heat throughout the day and I'm under pressure, you're not going to hear it in my voice. You know, how I manage my trades going forward has nothing to do with any trades that I just got out of or that I'm still managing. Right? Because I know that I'm trading based on order flow. I know I have an edge, and I know that although I'm losing, I could be losing right now, I'm losing on the day, I know that as long as I stick to my edge and I contain my risk, I'm going to come out ahead over time. You see it over and over and over again. And with what I know now, I realize that it's, you know, it's really borderline ridiculous to assume or predict that the market will go to any price. You know, it just goes where it's going to go. You got to just get with the flow of what the market is doing, what the order flow is doing, where levels the inventory are at. You know, a bunch of stops just hit, then you can assume that there's going to be an inventory transition take place. You can assume that there's a good chance that demand is going to dry up, right? If a bunch of short inventory just got taken out of the market, but we can't assume that we know where the market's going to go from there. You know, we're not predicting prices, we're not predicting market action, we're just watching it and using what's happening to our advantage. And this is what professional traders do. As traders, you have to accept the fact that we live in a world of uncertainty. Unlike just about any other profession out there, or career, or job, or business, you know, there's very few that you could think of that have so much, you know, uncertainty or level of uncertainty attached to them on a day-to-day basis, on a minute-to-minute basis throughout your day. You have to become okay with that. Most traders don't ever become okay with that, mostly because they don't have an edge. But there's traders that come along that I work with, a small percentage, that still continue to look for the Holy Grail, that 100% winners type of program out there, because they think it's out there, because they can't deal with, even though we have an edge, we can say we understand what's going on with the order flow, there's still an element of uncertainty that anything can happen at any time. The majority of traders spend the majority of their time seeking certainty in a world of uncertainty. And each new indicator they come across, they believe that they've found a touch of that certainty until they realize that they haven't. Then it's on to the next indicator. But when you get to a point where you're truly able to accept the risk when you get into a trade and the true unpredictability of the market, then you know that you found an edge. And that's what we have here, guys. It's undeniable edge. You know, you see it in my trading. You hear from traders that have gone through the training, and they're able to look at the market from a different perspective and trade with an edge now. That's what it's all about. It takes time. It's a process. Don't think just because you ended a 2 week workshop now that all of a sudden come tomorrow magically you're going to be a transformed trader. You know, yeah, you have a different perspective. You're well on the road. Some of you might already be trading with live money and applying the principles, but you don't have to be at that point just yet. You know, you should be able to start to make sense of when an inventory transition is occurring. Here's things that you should really be able to do at this point. You should be able to identify zones. The zones that you're identifying, your market map, should be relatively close to mine. You should be able to identify the major inventory transition levels that are occurring in the market ahead of time. You should be able to recognize when the market gets into one of these inventory transition levels and understand, what's going on in the market during that inventory transition. Remember the three footprints in the order flow: the capitulation of losers, the taking of profit by the smart money, and then the initiation of new trades in the other direction by smart money. Those are the three steps that are occurring in every inventory transition. I want you to start to understand what's occurring when the market gets into an inventory transition level and we're getting into a zone at the same time, the synergy that's occurring there. And again, I don't expect you to be knowing exactly where you should be executing or understand position sizing 100% or trade management where your target should be exactly. All that's going to come with watching me, with conditioning on your own part. It's all about conditioning, guys. It's a never-ending process. Repetition, repetition, repetition. I'm sure the majority of you would say that you're in a much different spot than you were, or place than where you were 2 weeks ago. Things I was talking about 2 weeks ago probably didn't make much sense to you, where now I'm not going to say you're an expert. You can't expect to be an expert in 2 weeks at anything, really, but you should be able to have at least an initial level of understanding of everything that we've been talking about. And you should be letting go of that need for certainty, of that need to know exactly what's going to happen ahead of time, because you realize that anything can happen at any time. There's no magic formula out there. We gotta understand and agree with the fact that, number one, anything can happen. Number two, we don't need to know what's going to happen next in order to make money. Number four, an edge. What's an edge? Nothing more than an indication of a higher probability of one thing of happening over another. Well, actually, that's number three. And number four, every moment in the market is unique, guys. The market's imperfect. We're imperfect. If we stop and think about what makes a market, the unbelievable variable of individual people and traders that make up the market. There's never the same combination of exact same traders in the market at any one time. It's always changing. That's why the market is always going to be different to some degree. Certain conditions we look for, certain patterns that lead to probability and puts probability in our favor, but no two trades are exactly alike. Another thing that's helped me to continuously improve, not so much my trading performance, because my performance is very consistent, but as far as always growing as a trader, as far as position size, as far as adding different markets. And that's another way to grow, guys. It's not always about continually increasing your size in one market, although you could go that route. Another way to improve and increase your size is to bring other markets into the picture as well. A lot of different possibilities with this business, which way you take it. But you have to get to a point either way, whether you're just increasing size in one market or increasing your leverage through different markets. You have to get to a point where you truly don't care about the money when you're trading. I know that sounds counterintuitive, but if when you get to the point where you've trained yourself to not care about your ongoing P&L, you're not watching every tick up and down in your account balance and only focus on executing, you'll be better off, I promise you. And we'll use the old example of if you're in the table getting operated on, you don't want the surgeon to think about what he's going to be doing with the money that he's making off your surgery. You don't want him thinking about how many other surgeries he could squeeze into that day so he can make more money. It can't be about the money when you're trading, guys, when you're actually in a trade. It's going to affect the way that you trade. I'm sure everybody here has been in a situation where the amount that they were up or down in a trade caused them to ignore their rules or caused them to do the wrong thing at the wrong time because they were letting their P&L affect them emotionally and influence their thinking. And that's the thing. We don't want to manage our trades emotionally. We're looking at it objectively, and if it doesn't make sense to be in a trade anymore, at that time we're going to get out of the trade. It's that simple. So as far as the money, I mean, let's talk about shares of stock because we can't really get down in the S&P down below one contract. But I mean, if you could trade the S&Ps at a level where it'd be equivalent to trading like one share of a stock at a time, with your P&L moving around, and or let's compare it to forex, where you can trade literally, you could trade where it's 10 cents a pip, 10 cents a tick. You're not going to care about the money so much there, right? It's not going to the money's not really going to register any emotional response from you. That's where you have to get to when you're trading. And everybody has a level where they don't care about the money, or come at it from the other end. Everybody has a level where the money starts to really concern them and will start to influence their trading. That's the level where at this point in time you can't go above that level. As you continue to grow and mature as a trader, you become comfortable with your edge. You prove to yourself you can make money consistently. Then you'll be able to slowly but surely increase your size. But even then, everybody's going to get to a point, whether it's, who knows, 10 lots, 20 lots, 50 lots. Everybody's going to have a point where that money is going to affect them because of how much their account balance is moving around. And at that point, you have no choice but yet to back off and bring your size back down. And maybe you can get past that point at a later date, but at that point in time, you got to bring your size back down. I don't care if that means you're a one lot trader, two lot trader, whatever the case may be. But the trick is, start trading with position sizing at the level where you can ignore P&L and focus only on execution. Well, first of all, focusing on opportunity setting up and then execution to enter, trade management, and then execution to exit your trade. Then increase your size slowly. If you get worked up over the money, move back down, and at a later date you can move back up again in size slowly after you get a little bit more confidence. Got the market about to open back up here. Another thing about trading and probabilities, some people think trading's gambling. For me, it could be about gambling, but for other people, and we take advantage of the traders who use the market to gamble. In the real sense, if we're trading in the reality of the market based on supply and demand, and trading with an edge, then we're more of a casino if you think about it. We take the bets from losing traders. We decide where we want to trade, how much we want to trade. Think about how much of an edge that is, guys. We're not ever forced to trade. Big institutions, they're forced to trade because they need to execute their size. If they get orders that they have to get into the market, they have to figure out a way to get that inventory executed in the market. Casinos, they're forced to constantly trade, to take bets from gamblers, right? They're open 24 hours. They don't shut their doors. Us, on the other hand, we get to pick and choose. Such a extreme edge, guys, and that's why the guys that have been in here are used to me not taking. You might see a certain opportunity and I'll pass on it just because maybe one thing was telling me not to get in the trade, even though there was a couple things setting up, but maybe one thing wasn't lining up perfectly, and sometimes that's enough for me not to take the trade. I get to pick and choose when I want to trade. And if I could sit there day after day and hammer out consistent profits for the most part on a daily basis, why? It doesn't make any sense for me to get into a gambling mode, to get into the market just because the market's moving, you know? Can't put that pressure on yourselves, guys. The opportunities are there. The more time that you spend with us, you'll see that. Everybody that's gone through this session has been with us anywhere from what, 2, 3, 4 weeks now. You see the opportunity there on a daily basis, and I'm sure it's starting to make sense where you're not only seeing me pick up on the opportunity and point it out every day, but you're starting to pick up on it on your own. It's just odds-based trading. Everything to me is just, not that I sit there and calculate the exact odds. We don't need to know the exact odds. I just need to know, hey, you know what? Are the odds in my favor here? Are they great enough in my favor for me to take this trade? Or does it make more sense to pass on the trade? Same thing when we're in a trade. If we're in a trade and the market's coming into a previous supply zone and I'm long as the market's coming up, doesn't it make sense for me based on probabilities to take my profit there, even though the market could go higher at that point? If I have multiple units on, the market's coming up into a supply zone, I have to take some of that inventory off. That's the positive expected value play. That's the odds are telling me to do that the market's going to react at this zone. It makes sense to take my inventory off at this supply zone. So it's not just when we're entering the market, it's how we manage our trades as well. What makes the most sense? What really places the odds in our favor? Just remain, guys, remain in a state of being adaptable. Just realize that we have an edge, but that doesn't mean because we get into the market that the market can't keep going. Or it doesn't mean that we get into the market and all of a sudden unexpected news comes in the market from left field. Now let me just throw a caveat out here, guys. Something that I try to repeat whenever it comes to my mind, but so important. If you're in a trade, I'm not really concerned with what the order flow is telling me. If I'm in a trade and some totally unexpected news comes out of left field, natural disaster, something of that magnitude, odds are if I'm not getting out of that trade, I'm drastically reducing my size because anything can happen at that point. It just doesn't make sense when those rare events that happen in the market, and they do happen, but they're rare, those black swan events, it doesn't make sense to put money at risk in a condition like that. People that don't trade with an edge just don't understand that. But I know everybody here understands that. It just doesn't make sense when we could sit there and grind out a profit to put ourselves at risk in a time where there's a extra deal of uncertainty in the market. You know, there's always an element of uncertainty. But when there's an overabundance of uncertainty, we just stand aside. Let's see the cards before we choose to act. All right, guys, just some concept there on probability. If there's any questions on that, I mean, it's pretty self-explanatory. If anybody needs any clarification on anything, let me know. All right, let's do a little bit of a review here. And you know, as everybody here realizes by now, it's constantly review. You know, we review the same structure every 2 weeks, but we're constantly reviewing. Every day that we're together in a trade room is a review. Every Sunday night edge is a review. When you see me making zones, when you see me adjusting my inventory levels, talking about situations that I'd like to see in order to take a trade, this is all review. And the further you get through the process, the more condition you have, the more sense it's going to make to you as time goes along. But just keep that realistic perspective, guys. Very important. And we talk a lot about staying realistic during session one. You know, session one on Wednesday. What's today? Tuesday, Wednesday, Thursday. Session one of the next work group. We're going to start from scratch again. We're going to talk about remaining realistic, talk about an intro to the program, and then we'll get into an intro to zones themselves. But remaining realistic on what you expect from trading, what you expect from the training, how quickly you expect to learn. Very important. You keep a firm foot on reality. All right, guys. Let's review real quick. Let's review the 4 steps. And this is on the website for all you newer guys in the toolbox, members area toolbox. 4 steps in objectively quantifying order flow and supply and demand imbalance. This is our Bible, if you will. You know, these are the conditions that set up opportunity for us. Number one, always, for me, the first thing I always do, we're looking at the market. Where is the next nearest supply and or demand zone? We have to know our playing field. We have to know where our next zones are that we can lean on if we're in a trade, or initiate a trade if we're not yet in a trade. And we have to be aware of where these zones are. Always number one for me. If the market's in the middle, smack dab in the middle of 2 zones, there's no trade for me. It's that simple. As the market's getting into our zone, then we start to look at the order flow. 2 different types of order flow setups here on charts 1 and 3. Either an inventory transition level, which is basically a stop run, and we know about the dynamics that are occurring there. Is any questions on those dynamics, guys, about what's really happening in those 3 footprints? So it's that inventory transition or a divergence between order flow and price. And what is that telling us? If we see a divergence, guys, and just perfect longer time frame perspective divergence here last week Thursday, price popping up to new highs or challenging the highs, and amazing commitment in order flow, which started 2 days before on this swing high, or day before. Notice the difference here. As the market kept popping the swing high and heading higher, it would squeeze out all the short inventory. And then something occurred here. Something switched in the dynamics, right? The market made a high of 1230, but yet we started to show commitment. Every subsequent shot at that swing high in price, we had further and further commitment from shorts. They were absorbing any demand that was coming in here. Not only were they sticking with their previous inventory, they were absorbing all the buying that was going on here, adding to their position. So we have inventory transition or commitment in the order flow. We can use commitment and inventory transition on this chart. In the beginning, as a beginner, I'd like you to concentrate on the higher time frame transition levels. I'd like you to be aware of when divergence is occurring, commitment on the higher time frame. A lot of times this commitment is occurring on too high of a time frame for us to really take advantage of it. Obviously, we're not holding swing trades for a couple of days. But I'd like you to start recognizing when it's occurring. But more importantly, the inventory transition levels on chart 3, commitment and divergence on chart 1. It's these intraday levels of commitment that we see. You know, we had a couple this morning. Let's scroll back here. Find a couple quick examples here. Here's one right here. Oh, that's 5 a.m. Let's get to one after it occurred late morning time, because I know we had a couple in there. We had some good commitment in here, and we're taking this out of context. We don't know if the market's coming into a zone, but these are the type of tradable rotations. Doesn't look like much here, but you're talking about a 5-point rotation right here. And as scalpers, we're not taking that much out of the market, but you know, good potential. Very obvious proof of commitment. And again, we're taking this out of context. We're not really looking at was there an inventory transition occurring on a high time frame, or where the zone was up here. But you see the commitment in the order flow. Huge, huge clue, guys. Right? So as the market's coming up, coming into a zone, we have commitment from shorts. Very hard for the market to get through that previous area of sell orders as shorts are staying committed and there's that lack of demand coming into the market. Right? And that's what divergence is. Plainly just shows us commitment to the smart money. Commitment of the smart money to their short positions. If anybody doesn't understand that, please let me know. So we have commitment. We have inventory levels. We have our buy pressure, sell pressure. Now there was several opportunities today where we had the market coming into a zone and divergence from buy pressure, sell pressure. Now, some days, guys, you'll see me take those trades. On a day like today where I'm not aggressive, in fact, I was ultra conservative today, you're not going to see me take those trades. I'm going to want more confirmation from either commitment or some type of inventory transition occurring. But you see how the market respects our zones, and when the market's coming into a zone and we have divergence, probabilities tell us we're going to have at least a scalping opportunity there. You don't have to take those types of trades either. You can wait for more confirmation. And we're going to get into that in a second with the ag factor. The fourth confirming, or the fourth step, the fourth level of confirmation is just to be aware of our pricing levels, guys. You know, if we want to be a seller, make sure we're not selling at the bottom of a recent down move. Make sure we're not selling into wholesale pricing. Does it always have to be pure retail? No, it doesn't have to always be pure retail pricing. But be aware of exactly where you are as far as your wholesale retail price levels. You know, a lot of times you'll see me, the market's selling off pretty hard. making a new low, get a little bit of a pop up into a previous zone. We have a little bit of commitment, and I'll take the trade, even though maybe the market is pulling off of wholesale levels, maybe up, not even to the middle of the channel. Still a good trade, guys, as long as you're aware of where you are. You know, you're aware at that most current, you're aware of your location is still at the end of that most current swing up in price. All right, so those are the 4 steps, guys. We put those 4 steps, well, we use them in varying degrees with our ag factor, right? Depending on how aggressive or conservative we want to be. How do we control that? Well, these are all different variables. This is how we switch that dial on our aggression or on how conservative we want to be. My dial today was turned all the way towards conservative, so I was looking for major confirmation all around. I was looking for great trade location. I was looking for perfect condition and context of order flow. And I was using small size. All right, does everybody understand how using all 3 of those to the highest degree of confirmation is going to give us the most conservative trades? It's going to give us the most conservative trades, but it's going to give us less opportunity. That's all, which is perfectly fine. But you can adjust your level of aggression on every single trade depending on these 3 factors. Depending on your trade entry location. Are you right up to the zone, or are you a point below the zone? Are you in true retail pricing and trying to get short, or are you in the middle of the channel? Do you have an inventory transition occurring and divergence in the buy pressure, sell pressure, or just divergence in the buy pressure, sell pressure? That's going to tell you your condition and context of order flow. Maybe you just have divergence in the buy pressure, sell pressure as the market's coming into a zone. So maybe you're going to use less size because it's not your most ideal trade setup, but yet you sense, because of the context, that you have a good opportunity on your hands. All right, guys, so it's a combination of the 4 levels of confirmation and then the 3 different factors of how we control our aggression or how conservative we want to be in the market. Okay, guys, another thing, and the ag factor is also on the site, I believe. I posted it up there. I'm going to have to check. One other thing that I want to get up there having to do with all this is the 3rd piece of this, you know, putting together the 4 levels of confirmation, the 3 types of ag factor. I want to put together just a little list of different ways to actually physically enter the market. For me, and for you, as you mature as a trader, you're not really going to think too much about that aspect of it. You're just going to execute. And I know that sounds very ambiguous, but that's how it's going to get to, guys. You're just going to get to a point where you're going with the flow. Looks like a good trade. Let me put some contracts on here and monitor for continuation. Let me see if I get the response that I want to put on. Depending on how much confirmation I have will determine the size of the trade. But in the beginning, when you want more confirmation in a certain situation, you're going to look for different types of ways to enter the market. And I know, you know, everybody, same situation, but, you know, a lot of people get caught up on this. Because, perfectly understandable, new methodology. You haven't 100% all out accepted risk. You know, you haven't accepted that uncertainty to the fullest degree because you're still learning the methodology. Perfectly understandable. So you want a little bit extra boost, a little bit extra confirmation, a little bit extra, you know, something to get you into the trade. You understand there's an opportunity there. The clearest way to get in the trade, guys, is a stair step entry. Market's pulling into the area that you want to get into the trade. It's getting into the zone. You have your order flow condition in effect. And this is actually a new zone, guys. So this, actually, let me get rid of this because this zone at this time, let's see. $358. Okay, this zone had just formed. This zone wasn't here when price came down, right? It was this market development that helped form that zone. So the market's coming into our zone. We want to be long in this zone. Maybe we have an inventory transition. Maybe we have commitment. We're just going to kind of take this out of context. The most mechanical, in my opinion, because, I use that term carefully because our methodology is not mechanical, but entering in this fashion throws a little bit of mechanization into the process. We can get in with what we call stair step entry. Okay, the market's coming down to this point, and not even the best example here. Let me find a more extreme example, be more visually obvious, as the market has a lot of pressure. All right, let's just use that example. It's fine. Market's coming into the zone. We're waiting for the market to get close to the zone. We want to see a previous bar's high taken out, and that's going to prove our sell response, our buy response. All right, so we're not looking to get in on the downtick. We're looking for a little bit of a buy response. We're looking for that absolute visual clue that we can't, argue with. It's there, it's visual, it's telling us, you know what, the bar took out the previous bar's high. That's my signal to get long. I'm long the market. That's the most mechanical way you can enter the market. Okay, right here, it would be right here. In this situation, the market comes down, touches your zone, but you're not looking to get in because the market's still moving to the downside. You say, hey, you know what? I want to see at least a little bit of a buy response here. Market comes up, takes out the previous high. You're long up here. Now, depending on whether you're going to cycle inventory in and out or not, market comes deeper into the zone, takes out the previous bar's high again. So either you're just sitting with your inventory or you're adding inventory in here as well. But either way, that stair step entry is what's going to be getting you long into the market. And again, this isn't the best example. The market doesn't really seem like it was selling off pretty intensely here. But that's the first proof that pressure's kind of being let off a little bit. The steam's being let out from all that sell pressure. That's the first proof on the most micro level that you have a little bit of a buy response there. And again, that's not a cause for entry on its own. It's just a further step in our process. We've already clarified and quantified that there's opportunity here. We want to be long. How do we get long? Stair step entry. Second way is just placing your order like you see me do a lot, above the zone or right below the zone. Looking to get filled, on this case on the offer, or this case on the bid. If we're not getting filled, then we'll maybe start to bring some to the market. All right, so working an order at the zone itself, another way to get into the trade. Knowing you see what's happening in the order flow, you see the markets in the zone, you know that you want to be long, you want to try and get good trade location, this is how you're going to enter, right? The major downfall to the stair step entry is, in case you haven't already realized it here, is trade location. You have the extra confirmation, market's moving up, you get a buy response, but yet you're getting bad trade location. Here, you're getting ideal trade location, but not as much confirmation with the buy response at that point, right, as the market's ticking down here. third way to enter, which kind of can encompass both of these actual aids in entering the market, is the value transition, saying, you know what, I don't want to get in on the downtick, and we had a good value transition this morning. We pointed it out earlier. I don't want to get in on the downtick here, even though we had nice divergence. I think we had an inventory transition occurring. I want to wait for the market to pop above newly formed value, right? So I know I want to be long in here, but I'm taking the route of I want to see that the actual down auction has transitioned into an up auction. So I want to see the market break out of newly formed value and then take the first downtick, the test. All right, so that's a value transition. Again, we can go back to entry method 1 or entry method 2. Do you want to get the stair step entry, or do you want to get the downtick back to the top of the zone? So method number 1, stair step, you'd be getting long here as the market takes this previous bar's high out. Or entry method 2, you're just getting long here on the retest of the zone. Makes sense, guys? Here's another way to look for a little bit of additional confirmation in this situation. Maybe you don't want to buy the first push down into the zone. You say, okay, I don't need a full-fledged inventory transition. Let me see the market stop forming vertically to the downside. Let me see a little bit of a buy response, and let me gauge the commitment on the downtick. Let me gauge how much supply is coming into the market. What you're looking for here is a retest or a test of this swing low on less supply. All right, and that's what divergence shows us, is a retest on less sell pressure. All right, you see it right here. So you're not getting in here. You're not waiting for a full value transition, although at this point you might get it because you don't know if you're going to get this retest. But you could be open-minded here. And a lot of times, guys, you'll hear me say here, I'm looking for one of two things. I do this a lot. I'm going to wait for the value transition to take place and look to buy the downtick, or I'm going to watch the test now of that low. Watch for commitment. One other way, and it's a little bit more involved as far as cycling inventory, maybe a little bit more advanced, but it's to break a zone up. It's kind of hard to do in a 1.5 zone, but if you have a 2 or 3 point zone, the market's coming down into your zone or up into your zone, you know you want to be long there. Let me see a zone that was like partially. Okay, let's say this is the zone here. Let's make believe it's a little bit wider than what it is. We know we want to be short coming into the zone, and I'm taking this out of context. We're not getting into reasons why we'd want to be short here, but let's say we did. You could say, I'm a 6-lot trader. The most contracts I'd want on this location is 6 lots. Let me break that up into thirds. Or I'm a 3-lot trader. Let me break it up into thirds. I'm going to get 1 at the bottom of the zone. I'm going to place an order for 1 to sell in the middle of the zone and 1 towards the upper edge of the zone. So you're spreading your risk over the whole area of price, the whole zone. You're not taking any extra risk. You're not putting on extra size. Instead, you're really reducing your risk by spreading your risk over a wider area. Right? Rather than putting your 3 lots on at one spot, you're going to spread them out throughout the zone. All right. Better done with more inventory so you could cycle in and out. Market comes up to the top of the zone. Maybe you get filled, maybe you don't. Market gives you a point, point and a half in your favor, you're taking off some of your inventory. Market pops up a little bit higher. Either you're playing the top of the zone or the middle of the zone. You get filled again. The market sells off. You're taking off some of your inventory. Market comes back up. You put some of it back on. Market sells off. You're taking it off. Now you're totally back down to flat. You still have an order working towards the top of the zone now. Now you don't really want to work the bottom or the middle because you already did that a couple times here. Now you say, all right, if the market moves away from here, I'll look to sell an uptick into this bigger area, or if the market continues a little bit higher here, I still have my order working at the upper reaches of the zone. All right, you get filled up here, and now you start to cycle that inventory. You're looking at the market in zones rather than exact prices. And when you get to that point, you're really, what you're doing is extracting a great deal of profit out of the market, even though the market really hasn't moved that much out of that zone. You're just using that zone as an area to continually cycle your inventory and extract profit. As long as the original condition that got you into the market in the first place is still in effect. Very important aspect with cycling. Does that make sense, everybody? You know, more so for the older students, you newer guys, it's all going to be a little confusing at this point. Any questions on anything that we reviewed today or talked about? Probabilities. This is our foundation, guys. You're going to continually build on this. We're going to build on this together. You know, I'm constantly throwing some new information out there, but for the most part, it's all about your foundation. This is what's forming your foundation. The 4 steps: confirmation, the variable of different combinations of conditions that are quantifying opportunity for you. Number 2, how aggressive you want to be and the different variables that are involved there. Number 3, how are you going to actually enter that trade? And you don't have to have too many variables. You could stick to just, you know what? I like inventory transitions as the market's coming into a zone. That's the only thing that I want to look for. That's fine. That's my favorite trade. Inventory transition on the higher time frame as the market's coming into a zone is golden. Now you could stick to that. And then within that setup, that underlying condition, you could say, all right, you know what? I want to just perfect a stair-step entry, or you know what? I know that if the inventory transition is occurring as it's coming into a zone, I want to be in the market, so I'm just going to work my limit orders there. And if I'm not getting filled, I'm going to go in at the market. Just concentrate on that, guys. Don't try and absorb it all. Don't try and execute every type of trade that you could be executing. Right now, it's really more about recognizing opportunity than anything else. Everything else, believe it or not, is going to fall into place. The major step, and even though it's not hard, I would say the hardest part of it all is just understanding this foundation. When you have this foundation in place, and you own it now, it's yours. No one can ever take that away from you. Everything else is going to fall into place. Just a matter of repetition now and conditioning, seeing me trade these setups every day. And a lot of what you're still going to see me do might seem foreign to you. If there's a particular trade during the day that you don't get, ask me about it. You know, if I'm busy in the trade and I can't address it right that second, I'll get to it. We'll talk about it, you know? Absolutely. Encourage that. That's how we learn, by asking questions, guys. A lot of times I feel like there's not a lot of questions, you know, and I could take that as a compliment that I'm such a great teacher that everybody gets it crystal clear, but I'm sure that's not the case. I mean, don't hesitate to ask questions. I don't care if you ask the same question every single day. If there's one particular setup that you're not understanding as clearly as other types of setups or conditions, Let's review it. Because this is your foundation. And then from here, once you understand how to, you're recognizing what opportunity looks like visually on your chart, then you're going to refine your entry method. Then you're going to refine your position sizing and whether you want to be a scalper and a swing trader or a combination of both. It's not always easy to determine that ahead of time, and a lot of you guys know that because from talking with a lot of you before you started the course and then talking to you during the course or after the course, a lot of you guys switch from initially thinking you want to be a scalper and then you decide, hey, you know what, I don't want to be a scalper now, I want to be a swing trader, or vice versa, or you want to be a combination thing. That's perfectly fine. That's perfectly fine. Just keep an open mind. I prefer you keep an open mind, and if you decide that, hey, scalping is not for me, I'd rather be a swing trader, that's perfectly fine. Then concentrate on swing trading, the higher time frame. Alright guys, that's going to be today's session. We will upload the video of today's session to the members toolbox. Any questions from the newer guys on the getting into the members area? I'm going to stop this video here. That's it for today's session.